All right, everybody, welcome to the channel. Today we're going to talk about should you pay off your mortgage early or invest? Now, if you find yourself with extra money after paying all your bills, you might wonder whether it's better to pay off your mortgage early or should you take that money and invest it? Now, it's a great question, and especially since many people struggle to save, with the average American savings rate in America being really quite low right now. Now, before we dive into the numbers, it's crucial to understand how mortgage payments work. So, when you take out a mortgage, you borrow money from a bank, to go buy a home. And then you're just going to pay that money back over time and you got to pay interest. Okay, for a standard 30-year fixed mortgage rate, monthly payments include both the principal, which is the amount you borrowed, and then the interest, which is the cost of what you're borrowing. The way these payments are structured can significantly affect whether paying off your mortgage early makes sense, compared to investing. Okay, so let's dive into understanding mortgage payments, right? And the key to that is principal and interest and breaking that down. Okay, when you take out a mortgage, you borrow money to buy a house, right? Your monthly payments have two parts to it. You're going to have the principal and you're going to have the interest parts. The principal is the amount you borrowed, and the interest is the fee the bank charges you for lending you that money. Now, let's say you have a $400,000 loan with a 7% interest rate over 30 years. So your monthly payment is going to be about $2,660. Now, if you look at the amortization schedule, and an amortization schedule is a table that shows you how much of your monthly payment is going to go towards principal and then how much is going to go through interest over the life of the loan. Now, initially, most payments go towards interest. So when you first start paying, most of it goes towards interest. Now, over time, more of that payment will go towards principal and start paying down that principal. This helps you see how much you owe each month over the 30 years. Now, one thing you might need to know is how is interest front loaded? So what banks do is they front load interest payments, meaning in the early years, like we just discussed, most of your payment goes towards interest rather than reducing the principal. So for instance, in the first month of a $400,000 mortgage at 7%, around $2,333 of your $2,660 payment goes towards interest, and only $327 goes towards principal. A very, very tiny amount. Now, this can feel frustrating. Was frustrating for me for all the homes that I was paying on because you don't see much reduction in the amount you owe initially. And this is where I feel banks have a great scam going on since they front load most of that interest at the beginning of the loan. Now, total interest paid over 30 years, let's kind of look at that and see how much money that is. So over a 30-year mortgage, the total interest paid can be a lot. It can be staggering. So for a $400,000 loan, the number we've been using at a 7% interest rate, you would end up paying about $558,500 in interest alone. So this means your total payout for the house would be around $958,500. Even at a lower interest rate, the total interest paid can still be a lot. So at 5% interest, it'll be $373,000. And at 3% interest, it's $207,000. Now, understanding this is key to deciding, okay, are you going to pay off your mortgage early, or should I take that money, invest, the extra money that I want to put into the mortgage? So to take that extra money, invest it elsewhere. So here are some strategies to pay off your mortgage early. Let's talk about that first. First thing first, make extra payments. One effective way is to pay off your mortgage faster is to make those additional payments towards the principal. This reduces the overall balance, which in turn reduces the interest you owe over time. Even small additional payments like $50 a month can make a huge difference in paying down that quickly. Then the other thing you can do is just pay more frequently, right? Switch to a bi-weekly payment program or, instead of the monthly payments that you're doing now. By doing this, you end up making that one extra payment each year, which shortens the loan term and reduces your interest. Then the other thing you can do is do like a lump sum payment. People will do this when they get bonuses or they get a tax refund or a big windfall of money. They'll take that lump sum payment and then they'll put it down on the mortgage and pay it down. This significantly reduces your principal balance, cutting down on the total interest you'll pay over the life of the loan. Now, the other thing people do is they kind of refinance to a shorter term, and I did this on all my properties. I went from a 30-year to a 15-year. Now, if you're able to handle the higher monthly payments, going to that 15-year instead of the 30 can save you a ton of interest. And then blink of an eye, all your homes are paid off if you own rentals or even just your personal home. Like I said, I did this on all my homes, and it was amazing how quickly I pay them off, and now I'm cash flowing really well. The other thing you can do is you can cut expenses, right? So review your budget, find areas where you can cut unnecessary expenses, then apply the savings toward your mortgage, and you can make and pay off your mortgage quicker doing that. The other thing you can do, and I did this too, is just increase your income. Get promoted, start a side hustle, do something where you can make extra money and you take those extra earnings and you make additional mortgage payments. Now let's talk about using a mortgage calculator. This can help you see the impact of making the extra payments. So if you go online, any mortgage calculator, and you say, hey, add an additional $200 a month to my principal to pay down my mortgage, and it'll show you how quickly you'll pay it down and what year you'll pay it off. Okay, so next up, let's talk about investment alternatives to mortgage repayment. So the returns on the S&P 500, when you look at the S&P 500, the average annual return since 1957 is around 10.26%. After, accounting for taxes, that return drops to about 7 to 8% historically. This makes the stock market a strong contender for those extra funds that you were going to put into your home. So let's compare mortgage rates to the stock market returns. So if you consider your mortgage interest rate, if it's around 3%, paying extra on your mortgage would give you a 3% return, which pales in comparison to the stock market average of 7 to 8% after taxes. So if your mortgage rate is low, let's say around 2.5 to 3%, really investing in the stock market is likely a better use of your money. Okay, so let's look at the asset class performance, over 10 years. So if you're looking at different asset classes over, the past decade, you'll see that large cap growth stocks, small caps, and international stocks have generally outperformed mortgages with those really low interest rates like we talked about, 2.5, 3%. Most years since 2009 have seen positive returns, often surpassing the 3% you would have save on the low interest mortgage. So in summary, unless your mortgage rate is unusually high, which most people's are now, if you're getting a mortgage now, it's around 7%, investing often will provide you a better financial return than paying off your mortgage early. So deciding whether to invest or pay off your mortgage depends greatly on your specific situation, interest rates, and the comfort with the financial risk, right? Intangible benefits of paying off your mortgage, let's talk about that a little bit. One of them is going to be peace of mind. Paying off your mortgage can provide a great sense of relief, right? Without the burden of monthly payments, you might feel more secure and less worried about financial obligations, especially if you're going to retire or close to retirement. Then you've got increased financial freedom. So being mortgage free means you have more control over your income. The money once used for mortgage payments can now be redirected to savings, investments, or other personal things that you're doing. You also have emotional satisfaction. So owning your own home outright can just give you a deep sense of accomplishment and emotional well-being. It feels good to know that you fully paid off this house and it's something you don't have to worry about. The other thing you might be thinking about is legacy and security for your family. So without a mortgage, your home can be an asset that provides security for your family, and then it can be an inheritance free of debt, offering safety net for future generations, future family members. Now, personally, going to have my home paid off in 2024. I have several of my rental properties paid off. All these things have really hit me, more security, feel better, leaving a legacy of these properties for my kids. So it does give me great peace of mind to have a lot of these things paid off. Now, I hope you found this video helpful. Give it a thumbs up, hit subscribe for more videos, wealth building on real estate investing and making money, and let me know your thoughts in the comment section.